Okay, so before we discuss the session for materials, I want you to watch a video. I posted the link to the video in the weekly sessions of Saikai, which I can show you here. So if you go to our course website, it is posted under the session 4, weekly sessions. So under lecture slides, video mentioned in the slides. Click on that, and there's a link which is with the title diversification. Click on that, you can see the video. Okay, so while watching the video, I want you to think about two questions. Question one: what is the relationship between risk and return? I believe most people may have some prior impression regarding the relationship between these two variables. So keep this question in your mind while you watch the video. And the second question is, I want you to think deeper than the first question, because most people might answer the first question by saying that high risk, high return. And generally speaking, that's true. But I want you to think a little bit deeper than that while you watch the video. So will higher risk always imply higher return? And putting in other words, will higher return necessarily imply that you have to take higher risk? So keep these questions in your mind when you watch the video, and you can pause my lecturing now, and once you are done with watching the video, you can resume the recording. Okay, so here I assume that you have already watched the video. So can you answer these questions here? So I believe that most people would answer the first question by saying that there's a positive relationship between risk and return. And as we said, this is generally true. But what about the second question? Will higher risk always imply higher return? Actually, the answer to this question is no. High risk does not necessarily imply a high return. So uh, in the video, it mentions two companies. One is a swimsuit company. The other one is a umbrella company. So a particular feature of these two companies is that their stock may move in exactly the opposite direction, because the video assumes that there are only two scenarios with the weather in the future. One is a rainy day, the other one is a sunny day. And it turns out umbrella company would do well on a rainy day, and the swimsuit company would do well under a sunny day. And their stock price just move in exactly the opposite direction, just like what this graph shows. Asset A, if they move down, and then asset B moves up, and the magnitude of their movement are also the same. So now if you only invest in either umbrella company or a swimsuit company, then your investment will be subject to a lot of risk, right? Because you cannot fully forecast the weather in the future. But now, if you, instead of just investing in one company, you invest in both companies. So then, if you just invest half of your money in um, umbrella company and the remaining half in a swimsuit company, you can see that your return will be your average return. Actually, what we call here is the expected return, will be the same as before. Right? If you invest in just individual company, then the expected return will be 10%. But now if you combine both companies in your investment, your expected return will be the same, 10%. But what's the difference is that now you have eliminated all the risk. So now you can actually keep the same expected return. When you stand here, you're making an investment decision, right? Let's see. That's where you make the investment decision. Um, so uh, I think I had a little bit technical problem, but I think now it's okay. So that's where you make the this is where you make the investment decision. So when you stand here, you don't know the future, so you can only have some expected sense for the return. So expect return for either umbrella company or swimsuit company would be the same, 10%. Now if you combine them, your expected return will also be 10%, but now you have completely eliminated all the risk. And the reason you can completely eliminate all the risk is because umbrella company and a swimsuit company, their stocks move in exactly opposite direction. And if that condition is not satisfied, then you cannot completely eliminate all the risk. So that's a very extreme situation. But by taking this extreme example, we actually have, I believe we can answer the second question. The second question is will high risk always mean higher return? And the answer is no, as we said. And why no? Because think about if you just invest in umbrella company compared with you invest in both, your return, your expected return will be the same. But by investing in both, you actually can reduce your risk. And in this case, you can actually completely eliminate all the risk. So lower risk, you can keep the same return, but lower the risk. And that's another way to say that higher risk does not always mean high return. In this case, it's the swimsuit company, right? Or either swimsuit company or umbrella company. They have either of the stocks have higher risk, but their expected return are the same. So this extreme example has suggested the sort of complicated relationship between risk and return. So even though in most cases high risk may imply high return, but we do have to keep in mind sometimes that may not be true. So I want you to have such impression when we study this session's materials. So now let's go to the lecture slides and learning objectives. I guess you can just look at this yourself. So we can skip that to save some time in recording. So first we're going to talk about return, and then we're going to talk about risk, because our topic today is the risk return trade-off. So then we'll be talking about how to reduce risk, because most people don't like risk, right? They have like high return but lower risk. So how can we reduce risk? How can we effectively reduce risk? And then we're going to be talking about the risk return relationship under a well diversified situation, and that is um, the capital asset pricing model. And finally, we're going to be talking about the cost of capital. How does that relate to the topic we are talking about today? So the return here, as we said, always involves some uncertainty. That's why we call it expected return. So we have to be very, very careful because the expected return here means that once the return is realized, the realized return may be different from this expected return. So expected return may not be that unfamiliar to you. If you think about like the weather today, it's due to the inclement weather, our class is canceled. So there's some forecast for tomorrow's weather. So if you are working, if the weather continues to be bad, then probably you can stay at home. But if the weather turns out to be not so bad as forecasted, then you probably will continue to go to work. So depending on different situations, your actions will be different. And so but as of now, we don't know for sure what will happen to the weather tomorrow. But you can have some forecast, of course, but you can only assign a certain probability for the situations in most cases, right? Like the weather forecast, 90% is gonna be heavy snow, and 70% is gonna be probably intermediate snow, and 10% is gonna be sunny day, things like that. So my point here is that this expected um, situations may not be so unfamiliar. And turning to the finance arena, because in finance we are talking about numbers, and that's why we care about expected return. So how do we define expected return? Expected return is the weighted average of all possible returns, weighted by the probability of each return. Like in the example we just talked about, if the weather turns out to be bad, suppose my investment depends on the weather, like the umbrella or swimsuit case, right? If the weather turns out to be bad, then probably my return will be either way will be bad, and if the weather turns out to be good, then my return will turns out to be good. So we can have some certain return that's tied to a certain situation or outcome. We call that or economic states. So expected return is just taking some average of the different returns under the different outcomes. So how do we take the average? We don't take just the mathematical or arithmetic average. For example, if there are three numbers, we just add them together and divide by three, and that's what we call the arithmetic average. Here we're actually taking some what we call the weighted average, because we have some probability for future outcome, and if the one outcome has a probability which is high, then that means that outcome should be weighted more, right? Because it's more likely to happen. And that makes sense. So that's the definition of expected return here. Um, so putting that in mathematic terms, expected return equals, here is the sigma is the summation sign. So it's sum over P is the probability. So Pi here is the probability for outcome I. So it's like sunny day is outcome 1, and rainy day is outcome 2. Things like that. You can have various number of outcomes. And P, that's the probability, and R, that's the R is the return under that probability, under that outcome. For example, if it's rainy day, then the return might be 10%, and if it's a sunny day, it's gonna be 15%, things like that. And then the outcome, we can have N. Here the N stands for the possible number of outcomes. So in that in the video you just watched, there can only have two outcomes, so N equals to 2 in that case. So here it's the probability times the return under that outcome, the probability of that outcome times the return under that outcome, and then sum up all these product, and that becomes our expected return. So let's talk about one example so you may have a better idea about this expected return. So for example, we have an investment. We have $10,000, and we invested this $10,000 into stock market. And obviously, stock market performance will depend on the economic states. So suppose we have three economic states. One is the economy can fall back into recession, and we have assigned the probability of going back to recession is 30%. And then the second possible economic state or outcome is we can have moderate economic growth, and we estimated that 50% chance we ever have this economy state. And finally, the third scenario is that we can have a strong economic growth, and the probability will just be the remaining probability to the other two outcomes. So it's going to be 20% for the strong economic growth. So we have also determined out of this $10,000, if the economic recession happens, then we're going to lose $1,000. And under moderate economic growth, we're going to gain $300. And under strong economic growth, we'll gain $1,100. So under each economy state, we can also determine the return, right? This is the cash gain or loss, and this is the return, just simply by dividing this cash gain by the investment of $10,000. So that's why we get a negative 10% and 3%, 11%. So based on the definition, expected return equals the weighted average of the return under each economy states. So now let me use a OneNote to show working. So expected return equals, here remember it's based on the formula, it's I equals to 1 to n, since here we have three possible outcomes, so n equals to 3, and pi times ri, right? So if you write down this in a more straightforward way, that's gonna be p1 times r1 plus p2 times r2, return under the second economy state, and finally p3 times r3. So now let's plug in the numbers. Go back to the slides. The probability for the first state, P1, that's 30%. And return under this state is negative 10%. So plug that into here, 30% times negative 10%. and then plus the probability for the second state is 50%, and return under this state is 3%. So this will be P2 50%, and R2 is 3%. And finally, the probability for the third state is 20%, and return under this state is 11%. So P3 will be 30%, and R3 will be 11%. So you put these numbers into your calculator, you will get 0.7%. To save time, I just put down the number. You can double check whether you can get the same answer. So that's my expected return. So what does this mean, expected return? Expected return is my best guess for the return of my investment when I make the decision. So in other words, that's the best guess for the future return. And as we said, this expected return may be different from what we call the realized return. So what that means is even though we can have three possible economic states, but only one can happen, right? So if it's an economic recession, then return will be negative 10%. And this negative 10% is called realized return. And if it's a moderate economic growth, then it's going to be 3%. And so this is also realized return. And if it's a strong economic growth, then return will be 11%. So only one state will happen. But the problem is that when we are making the decision, we don't know exactly which state will occur. And that's why we have this expected return. So 0.7% is our best guess for the return of our investment. And the realized return, which is the negative 10%, 3%, or 11%, that's obviously different from this return, because only one state can happen. Okay, so that's the difference. So that's the expected return. What about risk? So for risk, we have three questions. What is risk? And two, now how do we measure risk? And three, how do we reduce risk? Because most people don't like risk. Right? So you may be tempted to answer the question of what is risk by saying that okay, risk means that I can probably lose my money. So if there's such a chance I lose my money, then there's risk. Yeah, some people may have such impression or intuition. But strictly speaking, this is not very precise or correct. Because risk always have to involve uncertainty. So if you know for sure that you will lose money, then there's actually no risk in that situation. Yeah, so only if that under some situations you may lose money, but under some other situations you may gain money, or you can have under any case you lose money, but the magnitude of losing will be different. That also counts as uncertainty. Right? So risk always involves uncertainty. So how do we, from that regard, how do we fill the blank here? Risk refers to potential, we can say, variability or volatility, right? In future cash flows, returns. That's what risk means. It's like in going back to our case, going back to the example we just looked at, we have three possible economy states. Right, so there's a potential variability for your return. The return will not stay the same, either negative 10%, 3%, or 11%. So under that case, we have risk. Okay, going back to this slide here, hence the wider range of the possible future events, the greater risk. Hence, the returns on common stock is more risky than the returns from investing in a savings account. So this flag should be more. Okay, so go to the next slide. So how do we measure risk? That's the second question. We use what we call the standard deviation to measure risk. So what's the definition of the standard deviation? It's a statistical variable, which means basically translating that into words is a bit complicated. So this is the square root of the weighted average. Again, it's a weighted average, and the weight here is again like the expected return, that's the probability. So it's the weighted average of squared, here's power 2, squared deviation. It's a squared deviation. So deviation of what? Deviation of each individual return, Ri, from the expected return. So deviation here means the difference. So it's each individual return minus the expected return. And then we have to take the square. So why do we take the square? Because if you don't take the square, then here we are only concerned about fluctuation. So negative. So if our return is lower than your average return or expected return, versus another return which is higher than the expected return. If you don't take the square, take the power 2, then these two deviations probably will cancel out, which means it becomes 0. But that's not the case, because here we are only concerned about fluctuation, right? If you have a positive return versus negative return, that exactly suggests the variation. So we don't want the sign of the difference to affect our measure, and that's why we have to take the square. When you take the square, negative also becomes positive. So the sign doesn't matter, and that's why we have to take the square of that. So then you sum up the product of the probability and the square deviation, and then you take the square root of that, and that's the standard deviation. And note that this standard deviation measures what we call the total risk. Later on, we're going to differentiate between two types of risk. So total risk basically is the sum of those two types of different types of risks. So keep that in mind. So let's look at the example. We have two investment options. One is the invest in a treasury bill that offers a 0.5% annual return. So generally speaking, we consider treasury bill to be risk-free. So that means here 0.5% is sort of a guaranteed return. And the second option is that you can invest in the Apple stock. Obviously, this investment involves risk, right? Because the stock price is always fluctuating. So here for for the stock of Apple, we further have three possible situations. 50% chance return will be negative, negative 5%, and 20% chance the return will be positive, 5%, and 30% chance the return will be positive, 20%. So the expected return for investing in Apple stock, you can follow what we did to calculate the expected return by multiplying the probability by the corresponding return and sum them up. When you do that, it turns out the expected return for Apple stock is 4.5%. So let me fill in the blank here. Uh, 4.5%. And the standard deviation, that's the part that some students may find a little bit challenging to calculate. So let me put that into my OneNote. 50. So based on the definition of the standard deviation, let me use the black pen instead of red pen. So standard deviation equals, it's a square root, summation sign, because it's a weighted average, and I goes from n to n. I goes from 1 to n, and here we have a squared deviation, Ri minus expected return and square. And I almost forgot the probability part. So that's the probability. And that's why that's the definition of the standard deviation. So now plug in the numbers, because we already calculated the expected return for Apple. That's 4.5%. So now let's plug in the numbers to calculate the standard deviation. And now I need a very, very long square root sign. Okay. So it's a probability under the first state, which is 50%. 50% times the return under this state, that's negative 5%. Negative 5%. And then minus 4.5%, the expected return. And then don't forget about square. So that's the first part. And second part, second situation, 20% chance times the return under this situation is 5% minus 4.5% square. Finally, the third state, 30% chance times the return under this state, 20%, minus 4.5%, then squared deviation. That's the square deviation. So plugging all these numbers into your calculator and do this work, you will find out the standard deviation will be 10.8%. So you can double check that. Make sure you get the same answer as that one. So let me fill in this blank here. It's 10.8%. So now stock of Apple is obviously also, by the way, what is the standard deviation for trade review? It turns out the standard deviation should be 0. And the reason is that trade review doesn't have any risk. So under any situation, the return will be the same, 0.5%. So there's no deviation from that expected return. And because there's no deviation, if you check the formula, this part is always 0. So 0 multiplied by the probability is also 0. Hence the standard deviation is 0. So the standard deviation of the treasury bill investment is 0. Because the standard deviation is a measure of risk, so from this very simple example, we actually have got some basic idea about the trade-off between risk and return. Higher risk, higher return, right? Because by investing in Apple stock, your risk is higher, 10.8%. But the return, your expected return is also higher, 4.5%. And by investing in treasury bill, your risk is 0. The total risk, standard deviation is 0. And your return is also smaller, 0.5%. So we have a basic risk-return trade-off. So stock of Apple is more risky, but it also offers the potential of higher payoff, right? So that's the basic trade-off between risk and return. So does this trade-off also is borne out by the historical evidence? More or less, that's actually true. So let's look at this chart from the book. So here we are comparing the, actually here's the realized return. So it's sort of approximate to what we were talking about. Because as we said, we are always concerned about the expected return. But statistically speaking, you can't have data for the expected return, right? What you can have is history, and history always offers the realized return, and that's why here it's kind of some only provides some idea about risk return trade-off, but precisely or exactly speaking, it's not the same as what we were talking about. So here we are trying to compare the risk return trade-off for 1, 2, 3, 4, 5, 6 types of investment. So one is you can see that here actually you can group the investment into two broad categories. One is stock, the other one is a bond. So within the stock market, there are two further investment types. One is you can invest in small company stock, and then the other one is a large company stock. And within the bond market, you can have further have four sub-market or four types of investment. You can either invest in long-term corporate bonds, or long-term government bonds, or intermediate-term government bonds, or you use treasury bills. But the point here is that these investments have different risk characteristics. So generally speaking, bond market is less risky compared with stock market. And within bond market, as we said, the treasury bills are generally considered to be risk-free. So obviously this is a minimum risk. And for comparing government bonds versus corporate bonds, generally speaking, we think that government bonds are less risky compared with corporate bonds. And within government bonds, intermediate term bonds is less risky compared with long-term bonds. So in other words, the longer maturity, the more risky of the bonds. And for the stocks, as we said, the bonds are generally less risky than stocks, but different types of stocks also have a different risk. So small company stocks generally are more risky than large company stocks. So here we have a kind of a prior ranking of the different risks of these 6 types of investment. Let's see whether the data matches what we have just described. You can see that the data, looking at the standard deviation here, the data, largely speaking, matches the risk profiles we just described, right? Treasury bills have the smallest standard deviation, followed by the um, intermediate term government bonds, and then followed by the um, long-term corporate bonds, and then followed by long-term government bonds. So here it has a slight anomaly, right? Because we said, generally speaking, government bonds have lower risk compared with corporate bonds. But here, the data seems to suggest the other way. Long-term government bonds have a slightly higher standard deviation compared with long-term corporate bonds. So that's the only exception based on our discussion for the different risk profiles of this investment. For the two types of stocks, small company stocks, they have a larger standard deviation compared with large company stocks, and both standard deviations are larger than the bond market, the bonds. So this is the risk. What about return? And return also matches more or less the risk. The higher return, higher risk, or the higher risk, the higher return. Right? You can see that the small company stocks, the return, the average return is highest among the six investments, and followed by the large company stocks, and then followed by the long-term corporate bonds, and then long-term government bonds, and intermediate government bonds, and finally U.S. Treasury bills. So generally speaking, the historical evidence or empirical evidence more or less matches our observation that high risk, high return. With the quantification here that the risk is measured by the total risk, which is risk here refers to the total risk, and which is measured by the standard deviation. Okay, so far we talk about the meaning of risk and the measure of risk, and we also compare the historical evidence regarding the relationship between risk and return. Because most people don't like risk, but they want a high return. So our next job is to talk about how can we effectively reduce risk. So that's what we call the diversification. So when we talk about diversification, um, we have to talk about portfolios, right? Portfolios means that instead of holding only one asset, you are holding multiple assets in your investment. So that multiple assets is your portfolio of assets. So when we speak of a portfolio, most people would probably have imagined that, for example, you buy Microsoft stock, you buy IBM stock, you buy ExxonMobil stock, you buy Google stock, you buy Facebook stock. So that's called a portfolio or diversification, right? Instead of only investing in one company stock, you invest in multiple company stocks. Yes, that's one type of diversification, but it turns out that type of diversification is less important compared with a broader picture style of diversification. What that means is that instead of choosing individual assets within a certain financial market, for example, the stock market, as we just mentioned the example, right? All these are stocks, so they are all of them are in the stock market. So instead of choosing individual assets within a particular financial market, what's more important in terms of the diversification is to choose, to decide which financial markets to invest in. So this is like the example we just look at the 6 types of investment here. Right? This is like the broader category of investment. Rather than choosing individual stocks or bonds, this is the more broader or higher order of the financial assets. And that's called, in the financial jargon, that's called asset allocation. So asset allocation basically means that you're deciding how much of your money to invest in the stock market, and how much of the money to invest in the bond market, and how much of your money to invest in the commodity market, and how much of the money to invest in the foreign exchange market, so on and so forth. So in other words, asset allocation is kind of a broader picture kind of investment. And then the next job is the more familiar case. Within each financial market, which from the first step, which is the asset allocation step, we have made the decision that how much to invest in each of the financial markets. Then the next step is within each financial market, which individual asset to choose. So that's like the more familiar case as we just talked about. So when we talk about the diversification, the reason we can diversify risk or reduce risk is because some type of risk can be diversified. And so some type of risk can be diversified, and it also suggests that some other type of risk cannot. Right? So not all types of risk can be diversified, and not all type of risk cannot be diversified. So basically, we have 2 types of risks. One is what we call the systematic risk, and another name is a market risk or non-diversifiable risk. So basically, this type of risk means that it affects pretty much everybody on the market. So what kind of events can affect anybody on the market? So it could be like tax change, right? A war, things like that. And nowadays, because the oil price affects a large part of the economy, so some people also consider the oil price as a type of systematic risk. So as long as a certain investment, as long as a certain risk affects a large number of firms on the market, we can sort of think about it as the systematic risk. So in contrast to the systematic risk, we have this unsystematic risk, or company unique or diversifiable risk. So this unsystematic risk only affects a small number of firms on the market. And sometimes the unsystematic risk can also affect the whole industry. But the point here is that it only affects a segment or non-significant segment of the economy. So that's the unsystematic risk. So what are some examples of unsystematic risk? For example, the CEO change, right? If the CEO, we have some leadership change, that's a type of risk. Most likely, it's only gonna affect the company which incurred that risk. And what about union or strike, labor strike? Right, that's also a type of risk. Most likely, will only affect certain company or companies, but not the whole economy or large portion of the whole economy. So that's the unsystematic risk. And unsystematic risk can be diversified away, right? I think it's very easy to comprehend. because systematic risk affects pretty much everybody on the market. So how can you diversify away that type of risk? Because the only choice for you to hold is to hold the market, the investment or assets within the market. But if each of those assets is subject to the systematic risk, then the systematic risk cannot be diversified away. The only risk that can be diversified away is the unsystematic risk. So that's like the back to the video we watched before we talk about the section 4 materials. We have the swimsuit company and um, we have the umbrella company. So the weather is a type of risk which affects both companies, but the weather here actually is also a type of unsystematic risk, because if you combine those two companies, this risk can be eliminated, right? In that particular case, it's completely eliminated. So this type of risk is unsystematic risk. It can be diversified away by holding a portfolio of assets. So let's look at this chart to understand the benefit of diversification. So this graph shows that the horizontal axis here is the number of assets, number of stocks in your portfolio. So generally speaking, the larger number of stocks in your portfolio, the more diversified your portfolio is, right? The vertical axis is the risk. It's the standard deviation. So you can see that this blue curve is a downward sloping curve, which means that the more stocks you hold in your portfolio, the lower the standard deviation. But look at this bottom straight line. This straight line measures the bottom of this curve. So the curve can approach this line, but can never go below that line. And this is the line which measures the systematic risk. Because no matter how diversified your portfolio is, there's always some type of risk which cannot be diversified away. And that's the systematic risk. So the part which can be diversified away, which is the height of this curve relative to this straight line here, that's the unsystematic risk. So that's the difference between these two types of risks. And the next very important principle is what we call the systematic risk principle. So this principle basically says that if you can do your homework by diversifying away, by diversification, then the part of the risk which can be diversified away will not give you a high return. And it is only the part which, no matter how diligent you are and doing your homework and diversify, that part still cannot be diversified away, cannot be eliminated, then that part of the risk will give you a high return. So that's what we call the systematic risk principle. In other words, this is actually very important if you think about that, because it provides a very important quantification for our general impression that high risk, high return. Because if you're talking about unsystematic risk, which can be diversified away, then unsystematic risk may not be associated with high return based on this principle. Only the systematic risk will be. So a more precise statement for the high risk, high return should be that higher systematic risk, high return. And later on, we're going to use a very simple model, simple mathematical model to capture that relationship. And that's what we call the CAPM, or capital asset pricing model, CAPM model. So how do we measure systematic risk? In a well-diversified portfolio, yeah, you are basically well-diversified means that all the unsystematic risk is killed, is eliminated through diversification. So only the systematic risk remains. And the systematic risk is measured by beta. So beta is the meaning of beta is the sensitivity of company stock movement to market movement. So think about how can we understand this? Why beta, this systematic risk is measured by beta, and beta measures the sensitivity of a company stock movement to the market movement. That goes back to the meaning of systematic risk, because the systematic risk means it applies to the whole market. So we can use the movement of the market to represent the systematic risk. So if a company's stock is more sensitive to that movement, that suggests the company is more exposed to the systematic risk. Hence, the company has higher systematic risk. So based on that definition, a stock with a beta of 0 has no systematic risk. So we should fill in the blank here as systematic, right? Because beta measures systematic risk. And a stock with a beta of 1, and going back to the definition here, 1, beta being 1 means that the company's stock movement has a sensitivity of 1, which means that if the market goes up by 1%, the company's stock also goes up by 1%. So the company's movement has the same sensitivity to the stock market or to the market as a whole. So if that's the case, what should be the return? Keep that question in mind, because later on we're going to answer that question using the model. A stock with the beta of 1 has systematic risk equal to the average or typical stock in the market. And the stock with a beta exceeding 1 has higher, right? Has a systematic risk, which is greater than the typical stock on the market. So in other words, the typical stock on the market has a beta of being 1. That's just based on the definition or the meaning of the beta here. Okay, so let's briefly look at this example here to have a better understanding of the different types of risks. So we consider the following information. We have two securities, security C and security K. So the standard deviation for security C is 20%, and the standard deviation for security K is 30%, and beta for security C is 1.25%, and beta for security K is 0.95%. So question 1, which security has more total risk? And because the standard deviation measures total risk, so obviously it's security K, right? And question number 2, which security has more systematic risk? Beta measures systematic risk, so that's security C. And 3, which security should have the higher expected return? As we said, only the systematic risk will give an investor higher expected return. So from that regard, because security C has higher beta, and beta is a measure of systematic risk, so security C should have a higher expected return. And finally, which security should have a more unsystematic risk? How can we answer this question? Remember, standard deviation is a measure of total risk, and the total risk is the sum of systematic risk and unsystematic risk. So here, the systematic risk of security C is higher, but the total risk is lower. Hence, the unsystematic risk must be lower, right? Otherwise, it cannot be balanced. So, which security should have more unsystematic risk? It should be security C. Okay, so diversification in practice. Um, to reap the benefits of diversification, we need to first the benefit of what's the benefit of diversification? Actually, this question is already clear after we have discussed the swimsuit versus the umbrella companies, right? We said through diversification, through holding both company stocks, you can actually reduce the risk, and in that particular case, it's completely eliminate the risk, but keep the same return. So here we can lower risk without sacrificing expected return, or we can increase expected return without having to assume more risk. So both strategy works. But then how can we effectively reach these goals? Yeah, these two goals, either lower risk and keep the same return, or increase the return and keep the same risk. In my slides, I said, but think about the effective strategy. Let's just use our mind to think about this for a while. How can you effectively diversify? Suppose you have two companies, right? Company A and company B. Company A and company B, they are in the same industry, which probably means that their stock most likely will move in the same direction. So in that case, can you effectively diversify your risk? Probably not, right? Because if company A goes up, company B also goes up. And company A goes down, company B also goes down. So we say that in that case, company A and company B, their stocks have positive correlation to each other. So if the two assets are positively correlated with each other, probably it's not a good idea to hold both assets if we want to reap the benefit, if we want to reap the benefit of diversification. To reap the benefit of the diversification, it's best to hold the assets which move either in opposite directions, or if they cannot be completely opposite, then it's better that their correlation, even though it could be their correlation is negative, which means that they don't move in exactly negative direction, opposite directions, but they still somehow in not in the same directions. Or even if they move in the same directions, but their magnitude got to be different, better to be different. So in other words, even if they may have positive correlation, but the correlation coefficient better to be small. So so once we have that general idea, how can we fill in the blank here? If two stocks are perfectly negatively correlated, the portfolio is perfectly diversified. The portfolio risk is eliminated, right? It's like the swimsuit versus the um, umbrella company case. So while hand building a portfolio, we should pick securities that have negative, right? As we said, it's better to have a negative correlation or low positive if we cannot find a negative correlated stocks to attain the best benefits for diversification. Actually, in practice, it turns out it's not very easy to find out two companies they have negative correlation. Most stocks or most assets they have positive correlation. So uh, if one company's stock or if one company's asset that moves in the opposite direction compared with the market, we see that company is counter-cyclical. So let me write down this word in my notes here. Counter. But this type of stock is hard to find. Most stocks are what we call the pro-cyclical. So that means when the economy is booming, these companies are also booming. When the economy is in recession, and these companies most likely their performance will also suffer. So that's what we call the pro-cyclical. Most companies, most industries are pro-cyclical. Counter-cyclical industries are hard to find. Some examples may include, for example, some outplacement agencies, right? Which means they are like headhunters. They help you to find a job. So when the economy is in recession, more people are looking for a job. So that may bring more business to those companies. So that's one example of counter-cyclical stocks or industries. But as we said, it's generally speaking, it's not very easy to find such industry or companies. So this is as we said, this is an example of a perfect negative correlation. And I believe we already talked about this asset allocation in terms of effective diversification has a much larger effect compared with choosing individual assets within a particular financial market. Our asset allocation is choosing which financial markets to invest in. Okay, so I also want to briefly talk about one example of asset allocation, and we can also see from here that the benefit of diversification, which means that we can either reduce risk but keep the same return, or we can keep the same risk but increase our return. So here we can have a baseline investment. So this is our like the portfolio A here. So baseline investment, we put all of our money in long-term government bonds. So 100% invested in this type of security. And the average return is 5.55%. And the risk, which is measured by standard deviation, that's 11.30%. So now if one investor comes up, and this investor is relatively risk averse, which means that he doesn't like risk, but he wants to keep the same level of the return as 5.5%, want to reduce the risk. And how can we diversify this investor's initial portfolio to achieve his goal, right? Because he wants a lower risk, so we add some investment which have a lower risk, and we know that treasury bills is a type of investment which is considered to be risk-free. So we add a large chunk of our investment to be treasury bills. And then so we reduced our holding of the long-term government bonds, but to balance, because the goal of the investment here, investor here is to keep the same level return. So we also want to have some investment which have a higher return. So we choose large company stocks. So in this particular combination of the portfolios, we have 63% of our money invested in treasury bills and 12% invested still in long-term government bonds and 25% invested in large company stocks. So by choosing these special weights, we keep the same level of the return, but look what happens to the risk. The risk compared with the initial case is reduced significantly, actually even by a half, right? So we have achieved the goal of this investor by keeping the same return but lowering the risk. What about the second investor? He comes up. He is not that risk averse. He actually doesn't care too much about the risk, but he's concerned about the return. He wants to keep same level of risk but have higher return. How can we help that investor to achieve his goal? Okay, because he wants a high return, so we want to increase the proportion of the investment which carries a high return, right? Which is the large company stocks. We just look at the historical evidence. Large company stocks compared with bonds have high return. So we increase our weight put in large company stocks. Hence, we also reduce our weight on treasury bills. So if we do that based on these special combinations here, uh, the risk is the same as the baseline case, 11.30%. But look at the return. Return goes up from 5.5% to 8%. So in other words, by using this kind of a stylized example, we have actually provided evidence suggesting that we can lower our risk but maintain the same return, or we can maintain the same risk but increase our return through effective diversification. And that's also provided some evidence suggesting that high risk may not imply high return, right? Based on this discussion. So finally, how can we capture the more precisely the relationship between risk and return, especially after considering the effect of diversification? Because based on the systematic risk principle, only the systematic risk, which is measured by beta, matters for return or expected return. So how can we capture their precise relationship? And that's based on this model, capital asset pricing model. So this model actually has one Nobel Prize. So this campaign model, it creates the required rate of return to the risk-free rate plus a risk premium for the systematic risk, because only systematic risk matters in terms of the return. So here we also have a concept called required rate of return. So what does the required rate of return mean? Required rate of return actually is also sort of expected rate of return, but it's a very special number of the expected return. So required rate of return has to be concerned about competition. Because in general, for any stock or any asset, you always have a competitor. So if your asset, for example, if your competitor provides 10% for their expected return, but your asset only provides 9% return, expected return, and because your competitor and you have the same risk profiles, the same risk characteristics, so investors wouldn't care about your risk because your risk will be the same, but they are concerned about your lower return. So if they are concerned about your lower return compared with your competitor, nobody is gonna buy and hold your stock. So in other words, the 10%, which is the expected return for your competitor, provides a minimum return that you have to maintain in order to attract the investors to buy and hold your stock. So that 10% is what we call the required rate of return. So going back to the CAPM here, again, the second blank here should also be systematic risk, right? Because CAPM is trying to capture the relationship between risk and return, and we know based on the systematic risk principle, the risk, the only part of the risk that matters in terms of uh, return is the systematic risk. So the model here is expected return or required rate of return equals RF. RF here is the risk-free rate plus beta. Beta is the measure of systematic risk, as we said, times the difference between this ERM, that's the expected return on the market portfolio. So generally speaking, we use some indexes, stock market indexes, to capture empirically the return on the market. So for example, the Dow Jones Industry Average, DJIA, or S&P 500 index, or S&P 1500 index, or sometimes Russell 3000 index. So all those are measures of the market return, and then minus risk-free rate. So notice here the expected return on the market minus the risk-free rate, we call that the market risk premium. And that's very, sometimes some students may be confused about the difference between the market risk premium and market return. And market return is only the first part, the expected market return. And market risk premium means that it's the market return minus risk-free rate. So you need to be very, very careful because different questions may give you different numbers. Some questions may directly give you the market risk premium. So when you plug in the numbers into the CAPM model, you don't have to subtract risk-free rate from that number again to plug in this equation. But sometimes the setup may only provide you the market return. So then you need to subtract the risk-free rate from the market return and then plug in this formula to get the expected return on the individual asset. Okay, so let's talk about some examples. Before we do that, let's talk briefly about the meaning of this equation here, the CAPM model here. So from CAPM model, it's a risk-free rate plus the second part. So the risk-free rate basically captures what we call the time value of money effect. So that's what the risk-free rate is trying to capture. So that's why, as we said, when we talk about the session 2 materials on the time value of money, time value of money has nothing to do with risk. So it's like saving your money in a bank and earn risk-free interest rate. So that part is captured by this risk-free rate. It's like your interest rate. And the second part is the premium that you have to provide to investors for them to bear the risk. So that's a risk premium. So this part is the compensation, the return compensation for bearing risk. So basically the expected return is the sum of this time value of money effect and the risk premium. So now let's go to this example. Suppose the market return is 12%, risk-free rate is 5%. What is the expected return based on the CAPM model? If beta equals to 0, what is the expected return? Here we don't even need to calculate. Expected return, if beta equals to 0, that means it's the risk-free rate. It's risk-free. So if it's risk-free, the expected return has to be risk-free rate. So this has to be 5%. So let's give this blanking, it's 5%. And now the second one is if beta equals to 1, what happens to the expected return? So if beta equals 1, we said earlier, beta is a measure of a systematic risk, which means it's a sensitivity of a stock movement to the movement of the market. So if beta equals 1, that means the movement of the stock has the same sensitivity as the movement of the market. So if that's the case, the stock has the same risk compared with the market. So if they have the same risk, same systematic risk, their expected return also has to be the same. So in this case, you also don't need to calculate at all. The expected return has to be the market return, which is 12%. So the only case you need to calculate is when beta equals to 2. So now let's plug in the numbers to calculate that in my OneNote. If beta equals to 2, we know that we can plug in the formula. Where's my pen? Sometimes it's so hard to find my pen. ER equals, so this square root is 5% plus beta times the, go back to the setup, market return is 12%, right? 12% minus 5%. So this gives me what? This is 5%, and the difference becomes 7%. Multiplied by 2, that becomes 14%. So finally, this is 19%. So expected return under beta equals to 2, based on the campaign model, is 19%. As we said, some questions may change the setup to be equals, let's say, equals 7%, right? Just to be consistent. So if the setup changes changes like this, then do not subtract 5% from 7% again to plug in the campaign model. Just directly plug in this market risk premium into the campaign model. And this is very important because based on my experience, this is also that many students commonly make mistakes. So you need to be very, very careful. And so that's the mathematical model. What about graphically? Graphic representation of the campaign model is what we call the security market line. So in this security market line, we try to plot the relationship between risk and return. And because now we know that the only part of the risk that matters for the return is the systematic risk. So systematic risk is measured by beta. So this security market line is capturing the relationship between beta and expected return. And from the campaign model, actually we know this should be a straight line, right? The slope of this line should be the coefficient on beta, which is expected return on the market, minus the risk-free rate. Or the whole thing here is called market risk premium. So the slope of this line, again, is the market risk premium. And that's the security market line. Okay, so that's it for the risk-return trade-off. And finally, I want to talk about how does this risk-return trade-off and associated calculation on the expected return have to do with the cost of capital. So when we speak of the cost of capital, when we speak of the expected return, in general speaking, we are talking from the investor's perspective. So for example, if I want to buy IBM stock, the expected return for IBM is 10%. So that's from my perspective. And the cost of capital is shifting the perspective from the investor to the firm. So now for IBM, as the management of IBM, if my expected return is 10%, then IBM management has to maintain the 10% return. So the 10% becomes a hurdle. Why it becomes a hurdle? Because again, it goes back to the required rate of return concept, as we just said, right? If you don't maintain 10%, your competitor will be 10%. So nobody is going to buy and hold your stock. So that's why your competitor's return becomes a hurdle for you. And how can we determine the competitor's return? We use campaign model, right? We use your competitor's return depends on its risk, depends on its systematic risk. So eventually, both of your company's return will be determined by your systematic risk. So that return becomes a hurdle for the company. The company has to maintain that minimum return. So that's why that return from the firm's perspective becomes the cost of capital. So later on when we discuss capital budgeting, then that's from the firm's perspective. When the firm wants to determine which project to invest in, for example, Apple determines the iPhone project, iPad project. Those are specific capital budgeting projects. So when the company determines the capital budgeting project, from the company's perspective, the expected return from the investor's perspective becomes the cost of capital. So the cost of capital will be the discount rate the company uses when they are making the capital budgeting decisions, when they estimate the value of a certain investment project. So later on, we're going to use this for the capital budgeting discussions. And that's it for the session 4 materials.